Hi folks, Scott here, and this is the wrap for Monday, June 10th. So sort of a quiet day here in the market. I'm going to add another moving average here. Turn that on. Format it. And it's going to be the 20-day moving average set to white. So check this out. A little bit unusual situation here. We closed today. This is the cash index, which is the most accurate means of measuring closing prices for an index and moving averages and so on. We closed right between the 10-day moving average, the 20-day moving average, which is the white line, and the 10-day moving average, which is the yellow or gold line. A little bit unusual to do that. Certainly the first time we've done that, I believe, this year, if not in a long time, frankly. So I thought it would be helpful going into tomorrow to show you the results of fading gaps after closing below the 20-day moving average but above a 10-day moving average. I'll use Gap Trader, my back testing tool. You can see the same. This is a scrunched up view of the same thing. This is a 5-minute chart here. And actually, hold on. We had a trade today. See that? That was a winner. Let's look at this. Yeah, so yesterday was the exact same scenario. Didn't realize it on Friday. We closed the exact same scenario. That's why the system, this is hypothetical, just backtesting data showed that it traded today. So there you go. It's happened about 60 times over the past 10 or 11 years, 50-50 in terms of which way we're likely to gap on the subsequent session. That would be tomorrow. And using an end-of-day stop, not something I use, but a good place to start one's analysis, it does show slightly above average returns, both in terms of win rate and profitability for shorting up gaps. Now that does include today's winner, but even so, without that, it's probably still profitable. In fact, I'm sure it was. A down gap has average historical win rates, below average profitability though. Profit factor 0.6. It's lost a lot more than it's made. Profit factor is just a ratio of these two numbers here. So, well, you do have one large losing trade. The largest losing trade is shown there, which is about half of the total losses for buying down gaps in the scenario. But even without that, it's still a little bit weak in terms of profitability, and even though the win rate looks to be pretty normal. So I'll rerun these numbers for our members in the morning using our MTG stop parameters, but it's pretty clear to me, at least on the surface, this setup favors shorting more than buying a subsequent down gap. Now, as always, I will defer to our gap guides and my other analysis in the morning before I make my final decision, but there's a nugget to help you out. All right. Now let's take a look at what the worksheet showed today. I'm just going to show the worksheet for time's sake, because it wasn't a whole lot to see. The 8 individual indices, right, our 4 U.S. futures and 4 ETFs, showed an average win rate of 56% when targeting gap fill and a profit factor of 1.0 if opening above the prior highs. And all the indices opened above the prior highs. So that may look terrible, but remember that's assuming our MTG stop parameters, so it's just a little bit weak. Average win rate historically using MTG stop parameters about 60-62%. Profitability is about the same. So a little bit weak on win rate, not surprising if opening above the highs. And this is again across all 8 indices in 3 systems, so huge sample size there. Not bad, not good. Extended targets were pretty good. I'm looking for these 2 numbers here as a percentage of these 2 numbers to be at least 80%. In fact, I do the math for you on my worksheet. 84% of those that fill the gap went on to hit the extended target. That's a point beyond gap filled equal to 15% of the 5-day ATR. And profitability, it made even more profits. In terms of unique day factors, it was the Monday post-monthly jobs report. That's just a neutral to, I call that a neutral setup for shorting up gaps historically. Made a little bit of money perhaps. In terms of unique patterns after an unfilled up gap, big positive. 81% historical win rate, 2.5 profit factor. See up gaps after a 10-day moving average up straddle, 65% and 1.1. That's neutral. So nothing really not to like there. It's just the gap guides were weak. So as I showed in my pre-market comments, in fact, I ran with that unfilled up gap because everything I kept, my additional analysis that I do every morning, looked at a variety of scenarios, and the one everything kept pointing back to was the fact that fading up gaps after an unfilled up gap above the 200 in just about regardless of scenario had been really profitable. Check this out. If following a 5-day high close and not a 10-day high close, 18 of 21 wins, 86% win rate, and a 4.7 profit factor. If it's an unfilled up gap, it's also the second consecutive UH zone. So you had 2 consecutive UH zone gaps, and the prior one unfilled. Did not fill. 20 of 23 wins, 87%. So these are strong numbers. So bottom line, overall, gap got you neutral to weak. When I just now said it was neutral, right? But it's a little bit weaker than average win rate, and some of the individual indices showed weak probabilities for fading gaps up in the UH zone. The worksheet, however, was mostly neutral to positive factors for up gaps, especially the following Friday's unfilled up gap. So this is what I said. During more normal times, it would be a solid speculative short for me at the open, right? Because the data wasn't bad in the guides. It just wasn't good either. We had lots of positives. But this hasn't been a normal time past couple months. Up gaps have not performed well. I'm in a drawdown. I'm being very selective on up gaps and will continue to be selective until I see a little bit more, get a little more confidence and see a little bit more confirmation that up gaps are filling more back at historical rates. Because this year they have not at all. I may touch on that in my next quarterly wrap, which is coming up next month, I believe. So I waited, and the 15-minute range guides came out, as did the first hour range guides, and they were all about as neutral as you can get. There was just nothing attractive about them. And I missed an easy gap fill, which, you know, I think I was pretty clear. What I wrote at 9:20 was my view. Some folks did take it in part because of my comments, some of their own analysis. So good for you. I did not. It was a nice big fat win. That was 8 points. Holy cow. 39.50 to 47. But that's the cost of money management. And I would rather make less long term, but minimize my drawdowns than to sit here and just gamble. So decent setup, not good enough for my current situation in my core account. So I passed, missed a winner. After that, it bounced and then just sort of gyrated sideways. So this will probably be the most narrow range day of the past 7. That'll show up in a worksheet, which I'll post in about 20 minutes from now, about 5:20 Eastern time. Should be posted. Normally by 6 o'clock Eastern time, I have the daily worksheet posted. And tomorrow's the 11th. We had a false down day today. You might want to keep that in mind. Looking at a futures chart, see the red candlestick. So we closed higher, but with the red candlestick, that's a little bit unusual. And we also dipped above the 20-day moving average, which I'll add that filter and consider that tomorrow's one. Dipped above it after, then closed below it. All right, so there you go. That was my day. I did no trades whatsoever, no probability trades, no discretionary trades that met my criteria today, and it looks like I didn't miss a thing. So we'll see what tomorrow brings us, and that is the wrap for Monday, June 10th.